I am pleased to introduce and to be sitting with Harit Talwar. He runs the head honcho at Marcus by Goldman Sachs. And it was he who needed a new chair. That is the demanding nature of this man. Harit joined Goldman Sachs in 2015 when they were launching Marcus, and he joined as a partner. And he's got a lot of responsibility. So let's get right into it. Tell us a little bit about the origin story of Marcus. And I know you launched in October 2016, but it goes back a bit beyond that.
Sure. The origin, I don't know whether I'm qualified to talk about origin as a word, but multiple factors. But at the heart, I think it's a story about growth and absolute intense, passionate customer centricity. So the story starts a year before I joined. There was this famous offsite of the senior management at that time, Gary Cohen, who was the president of the firm at that time, at his house. And it was very classic Goldman to look at what's happening. And the firm is very client-focused, and it was, in this case, it was consumers. And they felt the trends were showing that despite all the consumer financial services industry, the consumers weren't happy. And there were multiple pain points, and consumers didn't trust financial services companies to be on their side. And as you know, in 2008, over a weekend, we became a bank. And Lloyd, our CEO, felt while we had built the controls and infrastructure of being a bank, we were perhaps underutilizing the concept of being a bank. Because we are we are the only large bank which didn't have a consumer business. And that was our real advantage, because we could look at things with a fresh piece of paper. We had no legacy distribution systems, we had no legacy technology, we had no legacy business models. We hadn't done things which consumers didn't like from their traditional financial services providers. And this is the Fintech conference. But unlike Fintech startups, we are a bank, and we are proud to be a bank because we've got the balance sheet and the DNA of risk management and the ability to build platforms which scale up. So therefore, what we thought, Jill, is that here we are with this unique structural competitive advantage, and we are really well positioned to transform consumer financial services in the country.
And it strikes me as funny because you have this startup mentality, but at the time, this is a 145-year-old institution when you're conceiving this. So what are the challenges and what are the advantages of that structure where you have the name brand, but for better or for worse, at that time certainly was harsh, harshly viewed by consumers. So how did you overcome that?
Well, have you seen Sound of Music?
It is perhaps after this interview, my favorite interview of all times was Julie Andrews, so okay, yes.
So that's a good way to put pressure, because I'm not going to compete with Julie Andrews. But, when you read, you start with ABC. When you sing, you start with Do, Re, Mi. When you build a new business, especially inside a large firm which has been there for 150 years, to build credibility, you start with the consumers. So we spoke to over 10,000 people, consumers, to try and understand what are their pain points. We ran those videos with senior management internally, hearing pain points which they didn't know existed.
And what were those pain points?
We can get into
at that time,
a long discussion, but fundamentally, if you look at in the US or around the world, there are three fundamental consumer pain points. One, people's relationship with money is broken. They are overwhelmed. There are too many accounts between cards and checking accounts and savings accounts and insurance and protection and all kinds of things. people are not in control. They don't like budgeting because they have a fear of budgeting. It's like, I don't like to go to a health club because I don't know whether I'll survive. People don't like to go to a...
I find that shocking.
At least it's a good story. So people's relationship with money is broken. Two, for those who need to borrow, the borrowing process is cumbersome, it is opaque, it is expensive, and it humiliates the consumer through the process. It is so insidious that if you apply for a credit card, even if you get declined, and more than 50% of the people get declined, your credit history gets impacted negatively. It does not need to be like that. And the third is that those who do save, they feel disrespected by the financial services industry. Because if you've accumulated, say, $50,000 of savings, you feel you've arrived, and you have. But the financial services industry doesn't treat you well. And while you can explain cost of funds and economic cycles and Fed fund rates, when I put money in a brick and mortar bank branch and I get 10 basis points, 0.1% interest rate on my hard-earned savings, I feel disrespected. We pay 1.7% on online savings account, and it is still profitable for us. Because we don't have all these costs which this 14,000 banks with 14,000 branches or more have built over time, and they are getting the consumer to pay for their legacy distribution structures and their legacy technology, and the consumers don't like that.
And when you started Marcus, you began with the depository side first? Is that where it started, or did it start with the lending side?
So we started building the lending side first, but then we had the opportunity to purchase the GE deposit platform. So in the market, we went in first with deposits. So if we step back, what really Marcus is, it's a 21st century platform, digital, open architecture, planning to serve millions of consumers with products, whether they are manufactured by us or distributed by us. But always the products have to deliver value, are simple, are transparent, and always on the side of the consumer. So in that umbrella, what we've done so far is, and we've been in business barely 2 years, we've got a personal loan product which helps Americans manage debt better, loans from $3,000 to $40,000, and we've originated around $3.5 billion of loans. We purchased the GE deposit platform. We grew those deposits from $9 billion to now close to $23 billion. We purchased around a month and a half ago Clarity Money, which is a financial management app with 1 million customers, helping people manage their budgets. And we are we are planning to launch our savings platform in UK later this year.
So that's interesting, though. What did that Clarity acquisition do for you besides bringing you these 1 million people? What did you see in this acquisition?
So we have been very fundamentally convinced to the initial pain point that people's relationship with money is broken, that there is an opportunity to provide a cutting-edge personal financial management app. It is not a mere matter of aggregating accounts, which some people do, but it is being on the consumer's side, being their advocate, and providing them insights. And so, for example, within the account, within the app itself, if it makes sense for you to open an account, you can open an account. And the account need not be a Goldman Sachs product. It could be Goldman Sachs, it could be non-Goldman Sachs. So we view this as our digital storefront. This is where we believe over time millions of consumers will come. They will get the tools and insights and experience and products to take control of their lives, financial lives. So we were committed to that strategy. What we particularly liked about Clarity Money is we liked the talent, the simplicity of their digital experience, and the data architecture and the AI engineers that they had. So it was a team of 26 people, and they are right now inside Goldman Sachs. We are very excited. We are working on various projects together, and we hope to integrate them fully into Marcus over the next year.
I want to see what that looks like, the sort of the young 26 people who have to now infiltrate into Goldman. I'm sure that there's some sort of transition period you're going to work them through. Do you have a psychologist to work with them to understand how to do that?
They look just like me.
Oh, yeah, that's perfect. Excellent. So you mentioned expansion into the UK. Will the same exact products work in a UK market as in a US market?
So right now we are going with a savings product. Our conviction is that any product in any geography must meet our brand pillars of delivering real value, no gimmicks, simple, transparent, and always on the side of the consumer. Now, the actual product configuration may change in each market, and the product has to compete in the UK marketplace, serving the UK consumer. But there also, as you know, there are 4, maybe 5 banks which have bulk of the consumer savings accounts, and they pay hardly any interest. So I think if people are interested in their money, they would like to move to something which is easy and more value.
So you talked about depository, you talk about lending, you talk about personal finance. You come from the credit card and payments industry. Talk about how that gets folded into a product by Marcus.
So our fundamental architecture, when we think of consumers' financial needs, is we look at their pain points, and then if you try and put it together, people need to spend, they need to borrow, they need to save, they need to plan, and they want protection. So that's the life, that's what they want, and they want it in a way that it doesn't overwhelm them. And currently, the aggregator of all this is a consumer himself. Now, if you're a billionaire with a family office, you have an army of people helping you do that, but not everybody is a billionaire with a family office.
Sadly.
Maybe sadly, maybe it's a good thing, I don't know. No value judgment. But that's really where we want to be, and we do think you're right. In the credit card space, there is a lot of innovation which is required. I have grown up in that industry. I'm not going to categorically dismiss it, but it is true that the industry has a lot of bad practices. And they want consumers to not pay their bill fully on time.
Right.
That is wrong, okay? Credit cards is great for spending. It's great for occasional borrowing. There's flexibility, which is good. And it's not that we are against credit card as a product, but we are against how credit cards today are being run. We think a really good card would give consumers the control, like cruise control, for example, in a car. Just because you can drive a car at 200 miles per hour, the car doesn't encourage you to do that. Credit card companies encourage you to utilize the entire credit line. We don't think that's a consumer-friendly thing to do. They charge you fees which you don't understand. We don't think that's a consumer-friendly thing to do. So we think there are a lot of disruption opportunities in cards too. If you truly take a consumer focus, we are not against the product or the industry. We are against the practices that are being deployed.
And so how will you incorporate that into your service offerings?
Well, over time in our product roadmap, we will look at cards. We will look at retirement planning. We will look at wealth management. And we are working hard on all these products. But right now, our focus is on making sure we scale correctly what we have, because we are really obsessed about customer experience. And we want to make sure that our speed is great, but never at the cost of customer experience.
I mean, you mentioned you're in loans and savings and personal financial management. We're talking about cards, we're talking about wealth management. Now you are essentially competing with every single financial firm out there, right? So if I think about like your broader aspirations, and you're also competing with a lot of these fast companies that are startups and really have some phenomenal products as well. So what are the competitive advantages that you think Marcus has to compete with both sides of the financial services industry?
That's a great question, and I'll break it up into two parts. The first is, and I don't want to sound cute about it, we are not competing with others. We are competing for consumers and for their interests. And frankly, our biggest competitor is consumer inertia. So for example, in our personal loans product, it is dramatically better for the consumer to take installment loans where they are in control rather than buying something on a revolving credit card line. Mm-hmm. But 70% of consumers are unaware. Our research showed that, if you have a backache, you talk about it. And then people tell you what you could do. But if you have credit card debt, and there are around 30 million people who have more than $5,000 of credit card debt, you're too embarrassed to talk about it. So it is consumer knowledge, inertia, awareness. That's what we need to, because we are not here to, I won't take names because, that's always impolite. And
that's sad. That's
a lot of them may be clients of the firm overall. We are not trying to replicate yet another fintech or yet another consumer bank. We are building for the 21st century. We want to be insanely consumer-centric. That is our mission. And as our president, David Solomon, said recently at an investor conference, we're very clear. We want to be very large. We want to be very differentiated. He also said we want to be profitable. But that'll be because of insane consumer centricity. Mm. Now, our advantage, as you said, is that we are a startup. We are a startup with a 150-year DNA. So we are a startup, and therefore we can look at things fresh. Number two is that we have a bank, we have a balance sheet, and we have a track record of building platforms which scale up. So I think unlike the fintechs, we have a lot of advantages, and unlike the banks, we have a lot of advantages. But these advantages mean nothing unless you can translate them into real value for the consumer. So for example, in our loans product, one of our research findings was, whether you're a bank or a fintech, you talk about loan amount, interest rate. That's not how consumers think about it. They think about it, I want $12,000, I can afford $300 a month. How long will my loan have to be? We do that because we have the technology to do that, which the large banks don't, but we have the balance sheet to make our product more flexible, which the fintechs don't, because at the end of the day, they have to securitize their loans, and therefore the loan terms are very rigid and very inflexible. So I think that's the kind of advantage we have. I think the other advantage we have is the whole technology and data architecture we've built. So we are very clear in our firm, in our business. Data doesn't belong to a particular function. It belongs to the whole company on behalf of the consumer. And therefore, our credit data, our marketing data, our site analytics data, our customer call center data, financial data, all of it resides in one place. And it is democratized to make available to every decision maker real time. those are the kinds of advantages I think we have.
Just want to finish up here with sort of a broader question. June 2009 was the official end of the Great Recession. So now it's our 9th anniversary. This is the second longest expansion on record, right? We just had the 7th quarter-point rate increase of the cycle. Clearly, things are changing. And I'm wondering, how is Marcus preparing to manage some of maybe the lower quality loans on the balance sheet? And how are you trying to communicate to your users and your clients what this new rate environment is going to look like and feel like to them?
I think that's very important. I'm not an economist, so this is not a Goldman Sachs economist pronouncement on the recession or lack thereof or when it is to be expected. But as a responsible lender, and we take that role very seriously, there are 2 points I would make. One is that while the macroeconomic environment is looking very good, consumer balance sheets and consumer debt is at the pre-08 levels. Mm-hmm. Now, if you are a lender and consumers have leveraged up again, you should be careful. The interest rates on those borrowings are low, but the interest rates will go up. Mm-hmm. All the credit card borrowings are on variable rates, which consumers may or may not understand. There is a large chunk of home equity lines coming up for repricing. So if you are a consumer lender today in the US, and you are not mindful that credit cycles happen, I think then you perhaps don't deserve to be a lender. Mm. Okay? And I really seriously believe that at an industry level, we've got to be careful. The second is at a consumer level, we are very clear a responsible lender is somebody who lends to people who have a demonstrated ability to pay. And you don't want to burden people with more debt than what is good for them. Now, we don't want to be preachy, because it's not our role to be preachy. But it is also not our role to try and sell a drink at a bar to somebody who shouldn't be having the next drink. Mm-hmm. We take that role very seriously.
How about the idea that the savings rate has now dropped below 3%? It's only the 3rd time since the financial crisis has happened. And yet, with the backdrop being that the economy does seem very good, is there some reason that we should have anxiety around that with consumers?
Well, the US economy has always been driven by consumer spending being a large driver of it. Consumer savings cyclically have gone up and down, but you've got to look at averages. I don't know what's going to happen. I'm not an expert on that, but I do think as interest rates increase, perhaps consumers' incentive to pay down some debt and do some savings would be there. Because right now, for most consumers, the savings option they have is putting money in their bank. And as our advertising campaign says, most banks only currently store your money rather than help your money grow, because the interest rates tend to be close to 0%.
So, Reddy, here's your last question. During the financial crisis, I'm sure you remember that Goldman Sachs was famously called the vampire squid. What is the aquatic mammal or animal or any animal that you would like to Marcus to be called?
Lovable teddy bear.
Oh, Harit Talwar, thank you very much.
Thank you. Nice to see you.
That was great.